November saw growth assets rebound over the month. Continued positive news around the direction of inflation in major developed markets and data supporting the view that rate tightening has peaked were the main reasons for the recovery. The current outlook on the direction of interest rates also helped defensive assets over the month. The key economic news came from the US, where the October Consumer Price Index figure came in lower than expected at 3.2% year on year, with core CPI hitting a 2-year low. This was driven by a fall in energy prices. However, the Fed continued to manage market expectations that interest rates will be higher for longer, and this is despite some signs that the world's largest economy is slowing down. The inflation story over the month was the same in the UK, with a higher than expected reduction in CPI, and the headline figure fell to 4.6% in the 12 months to October 2023. This positive economic news fed into growth asset performance, with all major indices making gains in their local currencies. Technology bounced back, and this led US equity returns over the month. However, it is Japan that continues to lead the way in gains this year, as investment has flowed from foreign funds into Japanese stocks amid expectations of stock market reforms and an end to its ultra-loose monetary policy after years of stagnant economic growth. This rally was despite Japan witnessing a quarter-on-quarter GDP contraction of 0.5% in the third quarter. In terms of factors, over November, stronger corporate results and lower bond yields meant the growth factor was the best performer. This also led to better returns from ESG portfolios, which have a growth bias. Smaller caps also rallied strongly, and this was at the expense of value stocks, which made the least ground over the month. Turning to defensive assets, government bond yields declined. The US 10-year Treasury fell beneath 4.4% by the end of the month, down from the peak of 5% reached in mid-October. Now, this was despite Moody's downgrade of the US sovereign debt outlook to negative, and the equivalent UK gilt also traded higher and now yields under 4.2%. Turning to the wider bond markets, the entire fixed income space has benefited from lower yields and the anticipation of rate cuts in 2024. Investment grade bonds gained in value, and rising hopes of a soft economic landing supported high yield bonds. So in summary, as we enter December and the last month of trading for 2023, investors will be paying close attention to the Santa Claus rally period. Now, this is the 7-day stretch starting from the last 5 trading days of the calendar year and carrying over to the first 2 trading days of the next calendar year. Since 1950, the wider US equity market has averaged a 1.3% gain over this period. Given the volatility seen this year, investors will be hoping for a positive finish for both growth and defensive assets as we enter 2024.